Do you ever stand at the grocery store checkout, look at your receipt and just shake your head in disbelief? Milk, eggs, bread, a little chicken for dinner. The total is somehow $20, $30, or even $50 more than it was a year or two ago. That feeling, your money doesn't stretch like it used to, is not just in your head. It's a very real force: inflation. The $20 bill today buys less coffee, less gas, less of everything you need and want. This isn't about spending more, it's about money being worth less. This slow, silent erosion of purchasing power is a major threat to retirement security. Think about it. The money you save needs to last decades. If it loses 2%, 3%, or 5% a year, your nest egg could be woefully inadequate. Inflation is like a leak in your financial boat. You might not notice it at first. If you don't patch it, you'll eventually find yourself sinking. Understanding this is the first step to taking control. We'll pull back the curtain on what inflation is, where it comes from, how it attacks your savings and investments, and 5 powerful, practical, accessible strategies you can use right now. Protect your wealth and make your money work harder. Let's get smart and let's get going. Alright, let's get this straight, because you cannot fight an enemy you do not understand. Inflation is the rate at which prices rise, and the purchasing power of your currency is falling. It means your dollar buys less today than it did yesterday. Imagine you have a crisp $100 bill. A few years ago, that might have filled up your gas tank twice and still left you enough for a nice lunch. Today it might barely cover 1.5 tanks with nothing left over. The bill itself didn't change, but what it can buy, its power, has been dramatically reduced. That is inflation in action. Think of it as a financial treadmill that's constantly speeding up. If your money is just sitting there in a low-interest savings account, it's like you're standing still on that treadmill. Your savings might be earning a tiny 0.5%, but if inflation is running at 3%, you are losing 2.5% of purchasing power every single year. You are getting poorer without spending a single dime. Cash, while safe from market fluctuations, is not safe from inflation. It is a guaranteed loss over time. This loss of purchasing power is the crux of the problem. It affects every single financial decision you make, from your daily budget to your long-term retirement plan. The goal of saving and investing is to increase your future purchasing power. Inflation works directly against that goal. It silently eats away at your money. If you plan to retire in 20 years with $1 million, ask, what will that actually buy? If inflation tracks its historical average, it might feel like $500,000 in today's money. One of the most common types is called demand-pull inflation, the classic too much money chasing too few goods scenario. Low rates and more space needs drove housing demand, but there weren't enough homes for sale. Sellers charged more, and prices shot up. The same dynamic can hit cars, electronics, anything with a rush of buyers. Another major cause is cost-push inflation. It becomes more expensive to produce and ship goods, and higher costs get passed to you. Oil fuels delivery trucks, becomes plastics for packaging, and powers factories. When oil rises, costs across the economy rise. Companies raise prices to protect profits. You pay more at checkout. Governments and central banks matter. Financing deficits by increasing the money supply without more goods makes each dollar worth less. Supply and demand for money itself. Often done to stimulate the economy, it can unintentionally fuel inflation down the road. If businesses and workers expect higher inflation, firms raise prices and workers demand higher wages, a self-fulfilling cycle. Understanding these drivers is key. Demand, supply chain costs, government policy, human psychology, and its impact is measured very carefully. So how do we know exactly how much prices are rising? We can't just rely on our gut at the grocery store. The government measures it. The Consumer Price Index, or CPI, is a giant imaginary shopping basket. Gasoline, groceries, rent, clothing, medical care, even haircuts. Economists check prices monthly, compare totals month to month and year to year. The percentage change is the inflation rate. When CPI rises 3.5%, that benchmark ripples across the economy. It influences Federal Reserve interest rates and cost of living adjustments for Social Security. But CPI is an average. Gas may skyrocket. If you take the bus, that barely matters. If your rent jumps 15% while national housing is 5%, your personal inflation is higher. CPI gives you a target to beat. If official inflation is 4% and your portfolio is up 7%, your real return is 3%. That's the number that matters. CPI is the score of the game against inflation. Make sure your personal scoreboard is higher. Know your numbers and aim to win. Different investments react differently. Cash, bonds, stocks, real estate. Cash in checking, savings, or under the mattress is guaranteed to lose purchasing power during inflation. It's liquidity, not an investment. Holding too much cash for too long is like ice cream left on the counter. It melts away. Bonds are traditionally safer than stocks, but vulnerable. Buy a 10-year at 3%. If inflation jumps to 5%, you're effectively losing 2% in real terms as old bonds' prices fall. Stocks are ownership in businesses. Short-term, inflation can spook markets. Long-term, businesses can raise prices. Soda, software subscriptions, lifting revenues and, over time, stock prices. Real estate is a classic hedge. Landlords can raise rents to keep pace. Construction costs push property values higher. Tangible income plus appreciation. You must beat inflation, or inflation will beat you. It's a simple but profound choice. Put your money to work where it can outpace rising prices, or watch its value evaporate. Every day you leave money idle, you choose to let inflation win. We are not going to let that happen. Not on my watch. You would not go into a battle without a shield. Do not face inflation without a protected financial portfolio. The single most important strategy is diversification. Never put all your eggs in one basket. Spread money across asset classes that behave differently. Stocks, bonds, real estate, inflation-protected securities, a strategic mix. When one area suffers under inflation, another may thrive. The strong can offset the weak, smoothing returns and reducing overall risk. Build a portfolio resilient enough to weather economic storms without capsizing. Within stocks, focus on pricing power, essential products or services, strong brand loyalty, ability to raise prices without losing customers, the power company, the dominant smartphone maker, the toothpaste you always buy. Avoid hyper-competitive thin-margin industries. Commodities, oil, natural gas, agriculture, gold, silver, often drive inflation. A small allocation to a broad commodity fund can hedge when inputs rise. But commodities can be volatile. Keep it a small strategic slice, not the whole pie. Diversification is not about hitting home runs, it's about staying in the game and moving forward. Now let's get into tools built to fight inflation. Treasury inflation-protected securities. Tips: increase principal with CPI and interest is paid on the adjusted principal, a direct guaranteed inflation hedge. Series I savings bonds combine a fixed rate with an inflation rate, adjusted twice yearly based on CPI. When inflation is high, I bond rates rise, protecting cash. There are annual purchase limits. For money that must beat inflation, I-bonds are essential, ideal for emergency funds and short-term savings. Not everyone should buy a rental. That's an active business. Access real estate's hedge via REITs, portfolios of income-producing properties, apartments, offices, shopping centers, warehouses. Buy shares, collect dividends, stay liquid. The key: tips, I-bonds, rates and stocks with pricing power. Be proactive. You cannot wait until inflation is raging at 8%. Build an all-weather portfolio now, allocating a portion to these tools to defend your wealth. A long-term plan that incorporates inflation-resilient assets from the beginning keeps you safe when storms roll in. The taxman is always there, and inflation can make taxes more expensive through bracket creep. A 5% cost of living raise can push you into a higher bracket, even if your purchasing power didn't really improve. Buy a stock at 100, sell at 110. 10 nominal gain. If inflation was 6%, your real gain is 4. But you are taxed on the full 10. Inflation creates phantom gains that get taxed. Be strategic. Prioritize 401ks and IRAs so investments can compound without annual capital gains taxes. Put less tax-efficient assets in tax-sheltered accounts. Consider long-term holdings and municipal bonds for potential tax-free income where appropriate. We have covered a lot. The economy is complex and headlines can be scary. Ignore the noise. Focus on what you can control. You cannot control the Federal Reserve, global supply chains, or government spending. You can control how you save, how you invest, and how you plan. Diversify your portfolio. Own companies with pricing power. Use TIPS, I-bonds, and REITs. These are disciplined, long-term approaches. A marathon, not a sprint. Build your financial house brick by brick. If needed, seek a qualified fiduciary advisor to tailor a plan to you. The greatest risk is inaction. Today, choose one small step. Get educated, get organized, get invested, open an IRA, buy your first I-bond, or call an advisor. You are stronger than you think. Be the guardian of your wealth and protector of your future. Your secure, independent, prosperous future is waiting. Now go do it. Like, subscribe, and share to help others protect their money.